Hello everyone, thanks for coming, and in this week we discussed emerging costs for traditional life insurance. One important thing for the insurance company to devise policies is to perform profit tests. In order to perform profit tests, we need profit test basis or the assumptions we need. First, we will need the interest rate, the initial expenses, right after setting up the insurance policy, the renewal expenses for each year. We also need the survival model, the survival probability, and the death probability. Then we can calculate the net cash flow for each year, which is the premium minus expenses for renewal plus interests from the reserve as well as the premium minus the death claims. To perform profit testing, we first need to calculate the profit for each year. For ith year, the profit PRI is the premium plus the reserve or the policy value minus the expense times the interest rate I plus I minus QX, this is a death claim, minus the policy value to be withheld for the next year, IV times the survival probability, Px. Combining the profits for different years together, we will have the profit vector, PR equals to PR0 to PRN. This is for the N-year term insurance. We also have the profit signature. Pi T is PRT times T minus 1, Px. So it is a probability that the insured life survives till time at the beginning of the Tth year, and the profit PRT will be realized. We also need some profit measures in order to evaluate a policy. First, we need the hurdle rate, also known as a risk discount rate, denoted by VR. So it is for when the contract is deemed adequately profitable if the internal rate of return exceeds the hurdle rate. So the internal rate of return is denoted by J such that the summation of pi t times VR to a power minus t to a power t is 0. VR is 1 over 1 plus t. So actually here VR is the discount factor and J is like the interest rate. The expected present value of future profits is the summation of each element in the profit signature multiplied by VR to the power t, the discount factor. We also have the profit margin. It is NPV divided by P times the annuity notation, A dot X to from X to the next N years. So it's like the ratio of the net profit divided by the premium, total expected premium to be received. Here, when calculating the NPV as well as the actuarial notation A dot, the risk discount rate is used. So it's a hypothetical interest rate or discount rate. We also have the discounted payback period. It is the smallest integer m such that the summation of pi t times VR to the power t is larger or equal than 0. So it's the minimum year for the insurance company to reach the break-even point, because we know that at the beginning of the policy, the insurance company is always losing money. as a result of the initial expense. So we need a certain period of time to reach the break-even point, and then after that the insurance company can typically make a profit out of this policy. Thanks for coming.